Thank you, Robert. I've not had a welcome like that for an investor presentation before, so thank you very much. Yeah, as you said, our results were out at 7 a.m. this morning, so the presentation from a compliance point of view was embargoed until now, so we didn't want to, we had to keep it confidential. So, yeah, we're from Caledonia Mining. We're a Zimbabwean gold business. I'll draw your attention to our disclaimer. I have copies of this presentation with me if anybody needs it to take home, and it will be on our company website as well. In terms of an overview of the business, we're the owner of the Blanket Gold Mine in Zimbabwe. It is a mine that we acquired off Kinross in 2006. We've had it now for coming on 12 years. It's been a fantastic investment for our business, and we believe we have a track record of investing against the tide in Zimbabwe. We owned it through the hyperinflation, through the difficult times in Zimbabwe, and things are now turning around in that country quite nicely, and we'll talk about that. I'm sure there'll be some questions. We're a Jersey domiciled business. We have a listing in London on the NYSE and on the TSX as well. We're pretty well cashed up with $13 million, just shy of $13 million in the bank. We're trading on a current PE of about 5 times. In terms of the scale of the asset, it's 56,000 ounces last year. So that's the size of the mine, and our all-in costs coming in. Well, this year we're guiding about somewhere between $845 and $890 on an all-in sustaining basis. We are investing to grow the production, and I'll talk through that. That's really the nub of the investment case. Is we're investing to grow production up to 80,000 ounces, and that will get our all-in sustaining cost down to somewhere between 700 and 800. Resources-wise, we have about 1.6 million ounces, so reasonably a pretty good resource life at the moment, about 14 years, but the mine's 100 years old and it's never had a 100-year mine life, so these type of mines do tend to have opportunities for resource extension. And we pay a dividend, which is unusual for a company of our size, but the yield's currently about 4%, so that is on the top of managing to invest to grow production up to 80,000 ounces. We've been paying a dividend since 2012. The yield used to be much higher. It used to be up to almost as high as 9 or 10% because the share price was languishing, and now, thankfully, the yield has dropped in the way that we like to see the yield drop in terms of share price rising. I did mention our results were out this morning. It was a healthy set of results. The business has been growing. We've invested quite substantially in really since 2015, and we've got 2 more years to go of that investment. And we're getting to the stage where we're starting to bear, we're starting to see the fruits of that investment. Not all of it, but we're starting to see the results of the funding. The numbers I draw your attention to really, we turned over about $70 million. From that, attributable profit to our shareholders. We don't own 100% of the mine, and I'll explain the ownership structure later, but attributable to our shareholders was just shy of $9.4 million. Operating cash flow was very strong. This business generated $24 million after tax. For a business with a market cap of $70 million, that's quite a healthy operating cash flow number. We reinvested most of that, and we're going to carry on doing that for the next 2 years while we're investing to get our production up to 80,000 ounces and to extend the mine life at depth. But after that, we think there's we're quite bullish that the operating cash flow will be able to support either other investment opportunities in the country or to grow the dividend quite substantially, and I'll talk through our strategy on that. And on an earnings basis, 135 US cents a share. That puts us on a current PE share price of about $7, so that puts us on a current PE of about 5 times. So we're in Zimbabwe. I don't know how closely all of you follow the news. Obviously, the retirement of Robert Mugabe last year and the change of guard. He was one of Africa's longest-serving leaders. We do think this has opened up quite substantial opportunity. Those of you who take time to review our press release this morning and our results, they have recently changed indigenization legislation in Zimbabwe. So previous legislation in Zimbabwe under the Mugabe government was that local Zimbabweans had to own 51% of all operating assets. So we are compliant with that legislation, but the legislation was changed as recently as last week, and that there's now no longer any legal requirement for local Zimbabweans to own 51% of the asset. So that does present us with potentially opportunities to acquire a greater stake in this asset. We obviously think it's a fantastic asset. It's been a great investment for us, and we obviously love to on a willing buyer, willing seller basis, look at our local shareholders in Zimbabwe and potentially acquire a greater stake in that business. I'll talk through the cash flow structure in a moment in terms of how the ownership structure works. So we're in the southern tip of the country here. Now the town of Gwanda, our mine is down here in the Gwanda Greenstone Belt. Zimbabwe is a large country. This is about half the size of Germany, so it's a big place. The map of Africa is often distorted. These are the major gold producing or gold regions. This is a relatively typical Archean greenstone deposit, similar to what you would see in Burkina Faso or maybe the Abitibi in Canada. So it's not like the Wits Basin South African gold mines. These are vertical ore bodies that keep going deeper and deeper, which is why the mine's 100 years old. You just keep following the gold deeper. The geologists tell us that's where it came from. So I'm not a geo, but there's certainly great potential to continue at depth here. But just this region from, say, Harare down to Gwanda where we are, that region is the size of Burkina Faso. So not many people realize this, but before the year 2000, Zimbabwe was the third biggest gold producer in Africa, behind Ghana and South Africa. And it's only the decline in gold production has been, unfortunately, as a result of some of the very unhelpful economic policies that were implemented over the last 20 years. But the Zimbabwean gold region has essentially missed out from when gold was $250 an ounce to up to $1,900 an ounce and back to $1,300 and some change today. There's been very, very little substantial investment in modern exploration in this entire region the size of Burkina Faso. So it was bigger, in the year 2000, it was bigger than Mali, it was bigger than Ghana, it was bigger than Tanzania. This is essentially, in our view, at the risk of overselling it, this is a time capsule of opportunities. If you could think, well, if I could go back to when gold was $250 an ounce, what projects would I invest in? There's those projects that exist in Zimbabwe that we believe we have a competitive advantage in terms of operating in the country, and we believe that the changes in legislation are making that quite an attractive place to be right now. So what we've highlighted here, these are the dots you can see. It's not very clear on the slide, but the dots you can see, there are million ounce plus deposits, right? So we've got 1.6 million ounces of resource. We've mined historically over the last 100 years about another 1.2. So that takes us to a 2.8 million ounce gold zone just in the 3 kilometers of strike that we've got. Our neighbors down the road from us have got about 1.4 million ounces, and they've mined about 1.1. So this is just in the 3 to 6 kilometer area that we operate in. That's a 6 million ounce gold deposit. So this is the sort of the scale of these assets and what they potentially could offer with decent capital and large scale exploration opportunities. So that's the Harare area. That's currently produced over 4 million ounces of gold. There's a few others in the center of the country with Gweri. There's quite nice deposits around Bulawayo, some of which we're aware of, and then obviously down the bottom there, that's the Gwanda Greenstone Belt where we are. In terms of our capital structure, the number really that I suppose is most significant there, $12.8 million in the bank, so quite nicely cashed up. No debt. There was a few $100,000 in overdraft facilities, but no debt to speak of. We're capitalized at $74 million. So just to bear in mind that the business generated $24 million in operating cash flow after tax last year. It's quite a healthy number in terms of an operating cash flow yield. It's not free cash flow because we're sinking it into the ground, but when that project's over, we believe we'll be on some quite compelling valuations. Shareholders, most of the major shareholders are a company called Allan Gray. They're a South African institution. They own about 20% of the business, which they bought on market over the last 5 years. And then a range of, there's another organization called Sales Promotion Services, which we believe is a European private wealth fund. And then the rest of the shareholding is retail. Liquidity is an issue. We'd like liquidity to be better, and that's why we invest in time and effort in forums such as this. So liquidity is an issue, but Allan Gray bought 20% of the company on market, essentially just being patient and effectively not being too concerned about liquidity. We benchmark ourselves against the GDXJ. This is indexed back to 100, so this is a 5-year chart. A lot of this outperformance here is actually the dividend. So when the dividend was yielding 8 to 10%, even now 4%, that is assuming the dividends were not reinvested in the company. If you'd reinvested the dividends, obviously that outperformance would have been better. But it is a track record we're quite proud of. particularly given the difficult operating environment we've had over the last few years in the country, which now looks to be certainly improving. This is our resources chart. I mentioned we had 1.6 million ounces. That's the number on the right-hand side, which is the most current number. We have invested quite substantially in exploration over the last 2 years, and we're starting to see that in the results of that exploration trend. But I think the encouraging thing is we've consistently grown the resource base since 2011, and this is at a time where we've mined about 250,000 ounces from this deposit. So we've at least replaced depleted ounces and have managed to continue to explore. We certainly don't feel resource constrained as a business. So just a few comments on resources. This is a vertical ore body, as I said. So it's not like the Wits Basin where you can just drill out in every direction and get an enormous resource that extends in every direction. It is prohibitively expensive and logistically impossible to drill much more than 200 and 250 meters below us, because you've got to then step out and drill in from the side to get a decent intersection. So practically, until you've got development infrastructure and shafts down to depth, it is difficult to continue to extend the resource. So we're never going to see an explosion in this resource base. It's not going to grow very substantially. I think if I were a betting man, we will get this up to somewhere between 1.5 to 2 million ounces, and we'll probably keep it there for the life of the asset. As we continue to invest in the project and get deeper, we'll then be able to explore at depth. But there always is, to some extent, a judgment call on the part of investors that the deposit keeps going. We know the mineralization continues at depth. We just haven't been able to explore it with enough drill holes because it's practically impossible to do so. So this is a cross-section, just a bit more color on the resources. This is a cross-section of the ore body running north-south, of the ore bodies we exploit. So that's about 3 kilometers left to right on the page, left being south and north, right being north. And you can see we exploit a series of vertical ore bodies that extend along strike. These are some of the production shafts we have, and this is the new central shaft that we're sinking. But this is now, in terms of color coding, I'll just build the slide out. That is our existing reserves above the current infrastructure where we are. And then as you can see here, I don't know, well, that is reasonably clear there. This is some of our indicated and inferred resources at depth. So you can see these mineralized trends continue. This is actually quite exciting here. This inferred section indicates that this blanket ore body and this AR main ore body tend to look like they're joining up at depth, which is, you almost never get those lucky surprises in mining, but it does look like it's looking quite promising. That's inferred resource at the moment. It's not in the mine plan, but it does once we get down there and are able to drill it in more detail, we'll have some more encouragement, hopefully, to announce there. These are drill holes that have intersected more than 1.9 grams a ton of gold. So in terms of resource grade, we're mining at about 3.8 or about 3.5 grams. The grade of the ore body is about sort of 3.84 grams. But it's very wide stopes. So, we're mining in some places 20, 30 meter wide stopes. So almost the scale of this room, which is so essentially a bulk underground mining operation. It's one of the reasons we can keep our costs so low with what is essentially not a very high grade ore body for an underground mine. If you're mining underground in Canada at these sort of depths, you probably battle to make money. But because we've got these very wide stopes, it does make it economically it's a lot more cost effective. These are some of the exploration targets that we're looking at. So mainly where the ore bodies continue at depth. Over here on to the south end of the project, we just can't drill here because we don't have the infrastructure. But this is pretty high grade ore body. We've had some encouraging drill intersections where we can get. And if the gold keeps going, which is that's where it came from billions of years ago, it was kind of squeezed up into these fingers. If the gold keeps going, we have every reason to expect to continue following that mineralization deeper. There's also the potential for some additional targets in between, where we haven't really explored at depth. Like I said, we've only properly invested in exploration infrastructure in the last 2 years. The key to the investment case here is we're expanding production to 80,000 ounces. I mentioned there's a project we've invested $21 million last year. We're spending another 21 this year, and we'll spend another 21 next year to deepen the mine, invest in a new shaft, and open up infrastructure at depth. And this is really the bulk of the investment case. This is what's we think why the what presents the opportunity going forward. So you'll recognise that cross-section of the ore body. That's the existing resource base that you see in colour there. That's the 750 metre level. So that's where our historic infrastructure has been constrained. When we bought this mine in 2006, we had we had a production shaft, the main production shaft, number 4 shaft, which you see there in the green, which basically keeps us and has given us 10 years of life, so it did its job. But you can see all of the mined out stuff, the grey stuff, is above the 750 metre line, and all of the coloured stuff is below it. So that's where we've got to go deeper. That's why we're investing in a new shaft. That's the Jethro shaft. So currently, the men, our miners, come down Jethro shaft. They then have to walk. This is about 3 kilometres, right? These guys walk with a drill rig on their back. They walk potentially 2.5, 3 kilometres to get to the rock face. They then truck the rock all the way back along here and up 4 shaft, and then it goes to the plant. So this is not how you would build a mine if you were building it from scratch. It only looks like this because it's 100 years old, and you're kind of always bolting on with new infrastructure as you go, just as you keep extending things. So there's no way we would have put the Jethro shaft there had we understood this ore body the way we did 100 years ago. That's number 6 winch, which just gets us deeper into the blanket ore body, which is a slightly higher grade ore body. But this is our exploration opportunity here, as I mentioned. It's not quite as good a graphic, but if these ore bodies keep going, we're certainly comfortable that we'll be here much longer than our current mine life up to 2032. That is the central shaft, which comes down right in the middle. Those bulk stopes that I mentioned are these. Most of our production comes from AR Main and AR South. It's a brand new shaft. It's going from surface down to 1,300 meters. So it's a big project for Zimbabwe. It's one of the biggest mining projects by the platinum sector. It's going to open up 4 production levels beneath us, which obviously, from a production point of view, gives you much more flexibility. But also, then obviously gives you. You'll notice there's no resource down here. We have enough resource here to justify the investment, but this will open up and potentially get us drilling to greater depth. Our neighbours, who I mentioned earlier, are 3 kilometres away from us. They're already at 1.5 kilometres in depth. So, we have good reason to think that this ore body keeps going, and we're comfortable that this project will set us up for many years to come in terms of enabling it. That's what it looks like. So it's a decent real mining operation. Those are 6-foot tall guys. As you can see, it's a proper large-scale underground mining operation, which is second to nothing we've seen in Canada or Ghana or any of those places. This is what it means for production. So these are a historical production level, pretty much from when we restarted the mine after the hyperinflation. The target there, the key number is 80,000 ounces by 2021, and that's pretty much what it means for operating costs. This is just a volume game, right? This is a rock factory basically, and the more tons you move through the plant, the lower your costs go. So we're going to get our all-in sustaining cost down to somewhere between $700 and $800 an ounce there. And this is where the maths gets easy, I think. So we'll be an 80,000 ounce business at an operating margin of at current gold prices probably somewhere between $500 and $600 an ounce. You can do the maths for yourselves, but that's $40 million of EBITDA after taxes and minority interests taken off. That'll easily get us to earnings of certainly well above the current level where we are. If we consider that our current dividend costs us $3 million, and we'll be seeing spare operating cash flows many multiples of that once the capital project is complete, we feel quite positive about the future. This is probably the most important slide. I think if you remember nothing else, this is straight out of our cash flow statement, right? So the historical numbers you're seeing there, 15, 16, 17. The light grey is operating cash flow. The dark grey is investing cash flow, right? So there's also, we pay a dividend. I haven't put that in the slide here, but so in 2017, last year, the mine generated just under it was $24.5 million of operating cash. We invested just below $22 million, and we dividended back 3 to our shareholders. So we kept the cash balance flat, which is what you'll see if you look at our financial statements. This year, probably, if gold stays where it is, that we might do slightly better, but we'll probably be, the next 2 years are roughly the same. So we'll be pretty much sinking most of the profits back into extending the mine deeper. But then after 2020, 2020 capital drops quite substantially, and then down to 2021, we're at full production. That's where the free cash flow really starts looking quite compelling. And this is based on our current resource base. If you consider that our dividend cost us $3 million, we'll have spare distributable cash from 2021 onwards of 7 times that amount of money. So we could afford to grow this dividend quite substantially without breaking sweat, or take advantage of some of those investment opportunities in Zimbabwe. This is a dividend comparison slide. They tend to move around a bit. We're a reasonably high-yielding business, but I draw your attention to dividend cover ratios. You know, if in terms of operating cash flow, we generated $24 million last year, and we dividended back $3 million. So once the capex program's over, we'll be able to use our discretion in terms of that dividend quite nicely. So that's, I know I'm running short on time, so apologies. That's pretty much, you know, in terms of the investment case, we believe we offer substantial production growth in a region that is turning for the better. There's no question. If you look at what's been happening in Tanzania, you know, even the Zambians hit first quantum with $8 billion of tax charges this morning. So, you know, there's certainly other areas and other regions in the country, in Africa, are looking more difficult. Zimbabwe is certainly looking much better. We think geologically it's very attractive. The dividend yields we're still quite healthy, 4% for a gold mining business. It's quite good. We've got low enough costs, we believe, to back ourselves to survive essentially any conceivable gold price going forward. And we believe we have a good track record in country. We think our results speak for themselves over the last 12 years, and we feel pretty confident going forward. That's essentially all I got. Thanks for your attention. I don't know if there's any questions.